Alright guys, so this is a little TAB29 bonus section, and it's going to fit somewhere between, as a follow-up to the pieces of 10 based on trading results and observations. And so it's an enhancement to the TAB29 system, and the whole point here is to put extra pips in your pocket with TAB29. So I do have to step up a little bit and retreat from positions that you might have heard me make. It's not so much a change in course, although it is a little. I don't want to let my defensive ego prevail. It is a little bit of a change in course, but it's a better understanding of what's going on. So let me talk about what I'm really thinking here. So early on, as you know, if you've been following me for a while, the D word has always been somewhat of a joke, but we've kept divergence out of our trading. And part of the reason for that is divergence at higher time frames. There's just too much slush in it. There's no execution point, and the reason is we can have a price point that's divergent, let's say on a 60-minute or a 240 chart, and yet 20 pips later it's still divergent, and 20 pips later it's still divergent, and so there's no execution point. The slush, once it's shown itself a divergence, is too big. And so yes, when I'm teaching multi-wave and I'm trying to teach new paradigm, and old paradigm traders would be there as kind of new people, they would always, sometimes, especially in live sessions where other, people can hear them and see them chat or whatever, they would say things like, oh yeah, that's divergent too, that's why it's a good entry. And I'm like, shh, we don't say the D word in here. And the reason for that is that slush, that while it is divergent in that slush zone, the reason it can work in the old paradigm is you have a 100 pip stop loss. You have a 150 pip stop loss. So if it's divergent in multiple times in there and you see the first instance of divergence and you take it, the multiple slide that it continues to move and remains divergence doesn't impact you because you have a 150 pip stop loss. And so it was a turnaround signal, and you could take it because even when price continued to slide against you, it was in the safety zone of that stop loss. But that doesn't work at the 60-minute level to say, oh, there's divergence, I'll take the trade, because if you're using 10 and 3, you're going to be stopped out because there can be more slush in that divergence. So that's why I didn't want it around, because as the old timers saw it, it was a reversal point, but you don't want to see that as a reversal point in the new paradigm because you just don't have the stop to expand far enough to cover the slush that's around the divergence, where you might have 2, 3, or 4 multiple points that remain divergence over a 100 pip stretch. So it was always shush, it was always divergence, the D word, don't say it, it's evil, blah, blah, blah. So, and that's how it's remained for years and years and years. And so when the traders saw, what I would do if somebody mentions, I would always direct message them or private message them and say, hey, look, if divergence works for you, fine, trade it. But I'm not going to teach it publicly because it just doesn't fit with the new paradigm. So, how would I come about to make that comparison to why could I say to them it's okay? Well, in the same way that we have trend bars. Think of these trend bars that you see on tab 29 here. These are old school, old paradigm indicators. It's just that when you apply them to the 1 minute level, the slush in them is so small. It's typically 1 to 2 pips on the flips, and that's why we can get by. It fits within our 2 pip pullback strategy, is because it flips in that time period. You've also heard me say don't take this above 15 minutes. By the time you take this to a half hour, now these traditional indicators operate as traditional indicators do. There's too much slush. So it's not so much that I'm against divergence. I'm against divergence at upper levels because there's too much slush. Yet, just like I would be against trend bars, which are old paradigm indicators, being applied at upper levels because there's too much slush, yet we could bring it down to the 1 minute, 3 minute, 5 minute charts, and these trend bars are pretty good. Even at the 15-minute level, they help us understand things. If we have a scan, for those that trade with the harmonic scanner, if we have a scan on a 15-minute chart, if scale is in your favor, in other words, the CD leg of that scan is 150 pips, you can use the 15-minute trend bars. directly off the 15-minute chart, because the 5 to 7 to 8 pip slush that a 15-minute trend bar has is well worth the risk reward for the potential trade. But again, if that scan gets too small, we can't have a 15-minute trend bar because risk reward goes away. So again, most of the time we try and bring our trading down to the 1 minute level, where we catch the last of the 1 minute waves and we're okay. All right, so all that being said, divergence was not taught. It was, shunned away. Don't say the D word. Shh. And then along comes quickfire. So for those that are Pip Club TAB29 traders and not trading harmonics, harmonic scans, the first thing I'll say is you're missing out. You're missing out big time. It's not a sales job. That's just a fact. And if you jump over to the Scans, Forks, and Fibos group, you'll see that. So if you trade with the scans, then we have a strategy called quickfire. And quickfire is a way of a non-harmonic trader, non-Pip Club trader, non-TAB29 trader, of saying, how do I know where that 15-minute scan endpoint really is? Because it can slide. And so there was a qualification process developed by another trader outside of our group, and the result was this quickfire where RSI is measured, the strength of RSI. There's a MACD used for divergence, and then there's Bollinger Bands. And so they bring divergence into the picture, but at this shorter term level. And even there, sometimes you have to be careful at the 15-minute level because divergence can slide. You have to be careful about seeing it as a turning signal versus it as a turnaround zone, which would require bigger stops than what a TAB29 trader is used to. So now we move you into TAB29, and we have the straight TAB29 trading where you have convergence to convergence as a money management, and we also have pieces of 10, and there's great places for pieces of 10. One, if the scale is big enough, pieces of 10 will give you more pips than going convergence to convergence in the same trade. If you have a smaller scale, then just going convergence to convergence is fine. The other place I like using the pieces of 10 strategy is where I have a 30-minute convergence, and I'll trade that first part of the 30-minute convergence as a TAB29 pieces of 10, because if it's going to slide, if it's going to be a snake, I'm not going to get bit. I'm not going to be up 10, 11, 12 pips and testing to see if there's going to be a wave 2 and it actually reverse and go up higher. And I just went from 12 pips up to settling for -3, waiting for the wave 2. So instead of doing that, we have the pieces of 10 strategy, which says get in at the convergence, write it up when that 1-minute wave hooks back, and I have a counter trend trade, meaning if I'm in the buy and I get the signal for a sell, that would be the exit for my buy. So we know how pieces of 10 works, and as an example here, there's a couple things going on that I want to point out, and they are now this scale is pretty tight here, okay, but I still want to show the concept because we have a couple of good examples in here of the concept. So if we saw this as a bottom, all right, 30-minute waves down there, the 10-minute wave converges into it, and for whatever reason this 1-minute wave just didn't come down low enough. Okay, well, a couple of things here. First of all, old school, we see this formation, and that is with this second candle, that is a morning star, I believe. When I have that doji wicks on both sides, at the top it's an evening star, and I believe at the bottom it's called a morning star. Nonetheless, whatever its name is, it's a candlestick reversal pattern. But it's 1 minute, so it could be short-lived. But indeed, the price is reversing at that point. So let's just go ahead and say, this was a convergence point. Let's go back over here. This one is the one I want to talk about. So convergence point. Well, you can see there, if I entered that trade, what should happen is I should be exiting up here by pieces of 10. 30-minute convergence for me, I'm trading the first one as a pieces of 10. And so when I get that hook back, and price is turning red, I can exit that trade. Or if the pullback comes 40%, and this would probably qualify on both to be an exit. So you don't make a whole lot of pips there. All right, you may go -1. It's better than -3. And I will take trades all day long that have potential to go far and take a -1 for 5 of them, 6 of them in a row. I don't -1. Come on, right? So that's okay. It even -3 is not bad in the scheme of things, because that's just 6 7/10 of a percent when you put 2% to a 10 pip stop loss. The bottom line is, what would happen if I exited here is now the tables turn. Sorry about that. The tables turn, and I can now get in here, because from a pieces of 10 strategy, we say, well, if this was a trade, then this is also a buy. I have a lower high, a higher low. I have a higher low, so this would qualify as a buy trade because it was a higher low. There's another reason that qualifies as a trade. There's another reason that qualifies as a trade. The reason why the higher low concept works in this case, and that is because I have divergence. And so coming in here, we went from that low to that low. I don't like the red in that case. It just doesn't show up well enough. So here we go. We come from this low to this low. And down here, we go from that low to a higher low. So that is divergence. And when I then get the green bars to go along with it, if I could draw straight, I have a trade. Whoops, a little over here. All right. So I have my trade. And that fits the pieces of 10. What we say is, if you saw that as convergence, or even if you didn't, if you saw that as an initial trade or a secondary trade in here, the higher low would qualify as another buy. And it makes sense. It's just in this case, the higher low here is actually a lower low in price. And that's why it's divergence, and that's why it works. Now again, 1 minute level, it doesn't guarantee you a 50 pip trade. It could be a 3 to 5 pip trade. It's just a 1 minute trade. But we're trying to find a bottom, so we'll keep trying. One of these is going to turn out to be the big move. So there's a great case where the lower low is okay here because I have higher low in terms of pieces of 10. So now, from a trading standpoint, I wasn't trading it as divergence. I was trading this as a higher low, and I didn't care if the price was in a lower low. All I cared about was this was a higher low, and I had a hook back, and I have green bars. That's a safe trade. And so in my 90-day period, this was, just trade after trade after trade. I could trust this hook back. And it was another trader who is also in Quickfire, who has been doing divergence testing, with Quickfire, also, having TAB29. So he's the Quickfire, which was Bollinger Band, RSI, and divergence in MACD. He was looking at divergence and seeing complementary divergence in some of the trades in terms of TAB29. So he comes to me and he says, hey, Steve, look at this situation. I go, yeah, that qualifies because it's a higher low. It doesn't matter that price is lower or higher here. The indicator is the thing telling us that there's upward pressure. It's a higher low. This is safe to take as a trade, even though the previous low was there. And so then he said, but yeah, that's divergence. I'm like, what? See, and I have to admit, this is a classic case of RAS. I've been so anti-divergence all these years that even though I was trading divergence and allowing it to be an acceptable move, because the indicator here said this was a higher low, this is safe to trade, I didn't even see it as divergence on the chart. So Stephen Ma pointed that out to me. Hey Steve, what we really have there is divergence. And I'm like, what? And it took me 10 seconds, and because now I was forced to look at it, and my RAS just had a little, orgasmic explosion because it was like, whoa, what's going on here? This is divergence. And so now I've looked at this time and time again, and some of you are already trading this. There's a subset of the TAB29 traders that were like me. They were trusting this secondary hook back because it was a higher low. They were trusting it to trade, and they found out most of the time it works. But it truly is divergence, which is pretty cool. But here's what's also kind of neat in this chart, and this is where you're going to pick up extra pips. Per our pieces of 10, affectionately referred to as pot, for our pieces of 10, if we saw this as the origin trade and then we took this trade because it was a higher low, this third pullback comes down lower. And so we'd say, we can't take that as a pieces of 10. And this is why a lot of traders said to themselves, I don't like Steve's pieces of 10 because as you can see here, this would be a disqualified move, and yet there were all the pips. So I would have had those, I retreated some. By the time I got in, spread, and got out, I didn't make a whole lot there. Maybe I went out at 0, maybe I went out at -1, maybe I went out at +1. Just depends on scale. No big deal, Steve says, just get back in. Well, this is not a qualified higher low, so that's a no buy. And therefore we forfeit all those pips. So a lot of traders have said, I'm not going to do pieces of 10. I do understand pieces of 10. If this 10-minute wave does go bottom to top, I can make more pips using pieces of 10 than I can just trading extreme to extreme. However, with pieces of 10, sometimes I can't get back in. And Steve says, well, don't worry about that, blah, 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 blah. Well, if we accept divergence and understand what it is, that's exactly what we have now, a second time. So we now have price at a low, and price goes to a slightly higher low. And here, price was at a low, and it comes to a lower low. Well, that's the outright definition of divergence. So what divergence allows us to see here, admitting it, is that this is an acceptable trade. See, by pieces of 10, that's disqualified because it's a lower low. But by logic, taking what we have with TAB29 and divergence, we see this as an okay trade. Now, some of you are already trading this because you've observed that these hookbacks are legitimate. If I have a hookback and I have green bars, I don't care where this is. And some of you have discovered that on your own because it still works. If you're a robot and literal, you've stuck to the pieces of 10, this would be a disqualified trade. To those that understand these hookbacks and the green bars that follow, always make this a very strong move, regardless of its relationship to this previous low. Whether it's lower or higher doesn't matter. And the reason it doesn't matter is because when it is lower and price up here is still higher, it's divergent. And that's why it works. So now, if you were a pieces of 10 strategist and trader, you have an exception to the rule, which says as long as the pullback is higher in price, even if this goes a lower low and would normally be disqualified per pieces of 10, I can now trade this because if it's lower and price up here is higher, that means I have divergence, and therefore that becomes, within scale, it becomes a trigger or a signal to go ahead and take this trade. So boom, there you go. We've just added to pieces of 10 the ability to capture those pips as well, regardless of scale. I think it's pretty cool. And this is now kind of building your RAS to a, you're approaching what would be that Jedi status where you can take multiple concepts and combine them into one. So I'm going to add this as an extra module, even though it's somewhat short compared to what modules normally are, to the TAB29 trading to follow up. It'll follow up all that stuff on pieces of 10. And here we have a disqualified pieces of 10 exception. And the reason it makes sense, once again, understand why this works. Where we don't want to take this trade, what I'm not saying, it's always okay to take the lower high here. I'm not saying that. If price up here was lower than this price, well, we don't have we have, continuation divergence. I'm trying to make these lines straight. If price is lower, so price comes down here lower, then what we have from a divergence standpoint is a low price going to a low, and here a low to a low. So that's not, that's just a dangerous. That's not a dangerous situation. That's an okay situation. That means we don't want to trade it because price should be continuing to come down. We want it to be divergence to tell us it's reversing. This is called hidden divergence, or it's not a reversal. So we can take this lower low only when asterisk 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 only when the pullback is lower. The pullback is a higher, the pullback does not exceed the previous low. That's what we have to see. This can be higher or lower compared to this. It doesn't matter. If it's higher, well, it's just standard pieces of 10. If it's lower, it's because of divergence. We're still looking for the hook back. We're still looking for the green bars. But now we have the ability to capture all these pips, and we're good to go. So anyway, if there's any questions, just ask it in the TAB29 group. But this is pretty powerful, and thank you, Stephen Ma, for shoving divergence in my face, because he allowed his RAS to expand from quickfire and divergence being okay there at a lower level, and I didn't. So my RAS was stuck after many years of being anti-divergence. So I grow some, and you grow some, and TAB29 continues to give us more pips. Any questions? Speak up. Pretty cool stuff. See you guys later.